Hey everyone, Nike stock and Pepsi stock, their valuation has come down considerably to levels that is attracting passive income investors. So in this video, I thought I'd compare these two and answer if passive income investors should buy Nike or Pepsi. So let's jump right in and consider the metrics to evaluate these two dividend stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Of course, one of the first things that passive income investors look at when they're evaluating a dividend stock is the dividend yield. And according to this metric, Pepsi has a better dividend yield at 2.97% compared to Nike at 1.38%. But more important than dividend yield is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why, in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you understand why that dividend payout ratio is important, let's look at Nike first. And you can see its earnings per share in the orange, well above its dividend per share for the entirety of the last decade. And that gap is growing wider, leaving room for increasing dividends per share for Nike. Pepsi also earnings per share above dividend per share for the most part in the last decade, but that gap is narrower and for moments it decreased below the dividend per share, suggesting that if you're looking for dividend growth, Nike could be better than Pepsi in terms of growth, even though Pepsi has a better dividend yield compared to Nike. The next thing I want to compare is cash flow from operations to sales. This metric measures what percentage of sales a company turns into cash flow. And according to this metric, they seem relatively close, although Nike's metrics are more choppy. It's more up and down compared to PepsiCo. Still, Nike in the most recent trailing 12-month period at 14.04%, compared to Pepsi at 13.25%. Nike is better than Pepsi, although very slightly. Longer term, I suspect Nike will increase this lead, given that Nike is shifting to a direct-to-consumer business model. It's relying less on wholesalers and going more directly to consumers, which could increase its profit margin because it's cutting out the middleman. And if it increases the profit margin, it's likely to increase the cash flow. And Nike has only recently begun this, only in the last few years that it's really increased the focus in this strategy. And so far, it's going okay. There's been some headwinds to this strategy, but it's hard to say that these headwinds have been due to the strategy or if the headwinds are due to the changing consumer behavior coming out of the pandemic, which both Nike and Pepsi have experienced, which I'll talk a little bit more about here. Revenue. For Pepsi, you can see revenue has exploded since the onset of the pandemic, growing from around 70 billion all the way up to 91.62 billion. Remember, Pepsi not only has its massive beverage business, but it also has a considerable snacks business, which is also lucrative for Pepsi. As people were spending more time at home, they were spending more time buying PepsiCo's products, including their snacks, and that was good news for Pepsi. As you could see, its revenue jumped ever since the onset of the pandemic. However, that's likely to plateau now that people are returning to work in person, returning to school in person, and so those benefits that Pepsi received, I'm not saying revenue is going to come back down, but it's not going to grow at the rate it grew in the last few years. Meanwhile, Nike has grown revenue close to 8 or 9% in the last decade at a compound annual growth rate, and I suspect that will continue for the next decade. Nike has some of the strongest brand loyalty around the world, and that allows it to sell premium products at premium prices. And now that it's going direct to consumer, that relationship, that data it can collect from consumers can help inform new product innovation that better matches with what customers are looking for. So revenue growth over the next decade, I suspect, will be better for Nike instead of Pepsi. Finally, I always want to look at valuation because a business can be incredible, but if it's too expensive, then it doesn't make a good investment. So even the best businesses in the world can be bad investments if their price is too expensive. So the price to earnings ratio tells us that Nike is slightly more expensive than Pepsi, trading at a forward price to earnings of 23.78 compared to a forward price to earnings of 18.9 for Pepsi. Still, if I was a passive income investor looking for a dividend stock to buy and hold for several years, I would choose Nike over PepsiCo because I feel Nike's prospects are better over the next 5 to 10 years than PepsiCo. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.